order for a firm to survive and to do well as a specialist, they have to have some kind of compelling value proposition and distinct edge. There's certainly an element of social proof to varying degrees around different organizations. The average CIO tenure is shorter than the life of a private equity fund. It's also not just that the incentives are broken per se, but they're highly variable. That's an area where we see the potential for a lot of conflict.
Hi, everyone. I'm Taiki, and you're listening to New to Venture. It's the show that uncovers the secret world of venture capital. From the multi-billion-dollar exits to the biggest company blowups, if you don't know that much about VC, you've come to the right place. It's time to get hyped because the one and only Nate Leung has joined us on the show today. Nate is a do-it-all human in venture, from operating at Rent the Runway and New Order to investing in startups at Bain Capital Ventures to investing in funds as an LP at Industry Ventures. Nate has paid his dues in all facets of the venture ecosystem. And now Nate is a partner at Sapphire Partners, investing in the best and brightest fund managers and demystifying LP land with OpenLP. So as an aspiring emerging manager, I am so excited to get his perspective on what it takes to raise and execute on a killer Fund 1. Nate, welcome to the show.
Thanks so much for having me.
Before we dive into all things startup and venture, I want to talk about some fun stuff. So I read somewhere that you're a huge sci-fi fan, and I think that's really funny. I think sci-fi and venture are inextricably linked because we just bet on what the future will look like. So when you look back at all the fun stories and novels that you've read, do you have a favorite one that stands out to you?
Oh, Dune is one of one of the ones that absolutely stands out. It's a multifaceted relationship, frankly, that I have with Dune, meaning the really find the complexity and completeness of these alternative universes so fascinating. Thinking about what futures could look like, and at the same time it bringing it to today, right, like helps me kind of bond with entrepreneurs, fund managers, other LPs, like this kind of it's just such an amazing genre for doing that.
Yeah, I totally agree. I remember I took a sci-fi class in high school, and that was by far my favorite class I took. I'm someone with a strong imagination, so I find myself thinking about what the future will look like all the time, not in the venture context, but just in general. And what I was also thinking about recently is being a parent must also force you to do that too. You're a dad. I've always been curious. Does having a kid where you're, investing in what the next 10 years will look like, does it feel like there's higher stakes now that you have a little you out in the world?
Absolutely. And, even to add to that, it's beyond 10 years, right? Like you're thinking about what 20, 30, 40, 50 years, may look like in the future. And this younger, smaller, version of yourself really forces you to kind of live that reality into time travel, which is, it's so fun. And to see the world kind of through their eyes and to remind yourself of that curiosity and optimism and, positive kind of orientation, in a job where you can't say yes to every investment opportunity. And in fact, most of your, most of the work tends to be, turning folks down and or being skeptical, right? And asking harder questions, keeping that close connection to like my kids' perspective, how they think about things, and then how they may experience things in the future, and the optimism for, the trajectory that tech and, capital and the two can really kind of bring for a great future. It's exciting.
Yeah. Hopefully when they become teenage time period of their lives, you can stay on top of the trends. One thing that I've realized is even now, I'm 25, I don't understand Gen Z lingo the way that I used to. There are all these terms that I am confused about, and hopefully having a kid will help you stay on top of all those things. I thought it was great that you mentioned something around time travel. I have this dream in my mind. At some point, I want to create a company that gets us as close to time travel as possible. I was thinking about what it really means to what is the closest we can get to time travel right now. And the way I thought about it was through sense or sounds or feelings that bring us back to a certain point in time. And so what I do now when I listen to music is I chronologically listen to music, right? So let's say I went on this big Asia trip last year, and I have a few set of songs that I listen to on repeat throughout that Asia trip. And so whenever I listen to that song, it takes me back to that moment in time. And my theory is, or rather, my dream is to create a company that can harness that sort of nostalgia. It's just more of like a personal thing that I want to do for myself, because I'm a total reminiscer. Anyway, that's a side tangent. I'm sure we'll talk about that later.
I love that. Can I bring that also back
please.
to books and literature, and actually my most recent experience in Japan? So I went to Japan for my honeymoon.
Congrats.
And so this is pre-kids, my wife and I. The book that I read right before and then during the trip is Musashi. I don't know if you've read it. Highly recommend it. I picked it up because Tim Ferriss talked about it on his it's like but as we were kind of going through like Osaka and like Kyoto and like just and like Tokyo and being able to, that was the time travel for me, right? Was like experiencing this book, like reading it on a train, and like seeing and just like experiencing like this place that hadn't been in decades.
Yeah.
Which is incredible.
Speaking of time travel, I want to take a moment to take a walk down memory lane. You've worked at some of the greatest establishments in technology and beyond. You were at BCG, Bain Capital Ventures, you did operations, Industry Ventures is an OG in the space. Sapphire Partners has such a great reputation in our land here. When you look back at your career so far, what were the key turning points? What were the big forks in the road that got you to where you are today?
Yeah, the thread that I think about it is kind of on two vectors that kind of connect all those experiences. And it kind of started with, as you had mentioned, like being a consultant and advising businesses, advising executives, kind of outside in, to becoming an investor, again, partnering with companies, founders, decision makers, and providing capital, and then into companies as an owner, right, as an employee, and somebody who's really, owning day-to-day decisions and impacting the trajectory of a company and an organization, and customers, right? So that's sort of the thread of kind of coming into the, where the real action happens, which is like, within these companies, that within these startups that are, growing and changing their industries. And then, kind of zooming back out to realizing that those relationships and the capital and the relationship between the technology, the organization, and the capital is what really kind of led me down the path of becoming an LP, and really where I see kind of the rest of my career, being as an LP.
Well, we're seeing in venture right now a very interesting time where there's this large exodus of top partners at top tier firms wanting to start their own thing. What's the distinction between great investors versus great fund managers? Are those different skill sets, or are they actually pretty similar?
This is an excellent question, and I'm glad you brought it up. There's certainly overlap, and I think it's very difficult, if not impossible, to be a great fund manager without being a great investor. Right. If that makes sense. Mm-hmm. And maybe maybe there's an analogy in sports around like, being a player on a field
Mm-hmm.
versus, management within an organization and or a coach. I think the goal of being a great fund manager is, I'll define it in Sapphire terms and in what we think about in terms of great fund managers. And that is generating consistently great returns over time for your limited partners, and for yourself, of course. But the key to that is really managing capital um, in a trusted, disciplined, and consistent kind of way. There are great investors who just don't do that, right? Who just like they generate great returns, but may not necessarily serve their investors um, in terms of providing an audit or providing a narrative for your investors to kind of go back to their organizations, right, and talk about like they may like there may be great dollar on dollar returns, or great IRR numbers, but at the end of the day, the great fund managers are ones who produce it consistently over time in a way that suits the investors, the LPs objectives, right? And I'm coming at this from primarily an institutional LP perspective, recognizing that the kind of difference, the distinction is really, you have people who are fantastic investors who can spot companies and get into incredible companies at the right prices and generate returns that sort of suit, maybe their own needs, but
Yeah.
not necessarily the needs of outside capital, if that makes sense.
See, that's so interesting to me. As a young person in VC, I never made that distinction. I thought all LPs cared about were just returns purely, but people often talk about founder VC fit. And you co-founded OpenLP, which is this huge initiative to sort of demystify GP-LP relationships, and what goes on behind the scenes there. Is there such a thing as GP-LP fit? That's where I'd like to start.
Absolutely. And I think the answer is sort of unequivocally yes. And it kind of goes back to some of the things we touched on a little earlier around great fund managers, meaning the LPs, the investors, have objectives. Generally speaking, there are return objectives, right? But they're also more than that, right? Like most of these, and again, I'm taking the institutional perspective, but most institutional investors represent organizations, they represent causes, they represent interests, right? And they're individuals. These are people who are decision makers and recommenders. And in that context, we'll have goals beyond pure numbers, right? Meaning, the person on the other side of a pitch or a diligence process or a conversation, they may be optimizing both financial return as well as a narrative that they can then tell to either help grow their own career or help grow their business, maybe multiple kind of different facets at the same time, but there are definitely interests beyond pure dollar for dollar
Right.
returns.
Something I had been quite interested in, a lot of LPs, from what I've heard, they don't want to get fired, right? They're hired by someone else to manage, money. So what makes sense is, you put it into Andreessen, you put it into Sequoia if you can get access, put it into all the big funds. You're expecting maybe 1.5x return, but you're safe and you don't look crazy. Any thoughts on that?
I definitely agree with that, and it's also not just that the incentives are broken per se, but they're highly variable across different pools of capital and different types of organizations. And also, if you take it back certain levels, right? Like you go to, so I'll give you an example. I don't want to misquote this, but the average CIO, tenure is shorter than the life of a private equity fund, right? or like the average CIO
Really?
contract is shorter than the life of a private equity. We'll put it that way, right? Like CIOs don't necessarily sign 10-year contracts, but their private equity partners, like they're partnered for
That
10
makes no
years,
sense.
right?
Yeah.
And then, by the way, you're absolutely right. Like in terms of the incentives, and that's at the CIO level, kind of cascading down to the team. Like how are folks compensated? It's typically on, there's some sort of incentive compensation based on returns, um, potentially, most likely in a shorter period, right? Than actual performance would indicate, and that leads to particular behavior because the incentives, may not line up with the duration, and or you have folks kind of managing career risk, managing situations, or things that are misaligned potentially, from the GP and or from the underlying portfolio.
Signaling plays quite a big role in our industry. Does it play the same type of role for LPs? Are there a few LPs that sort of set a certain precedent that the other LPs follow? What is the role of signaling in LP land?
Yeah, there's certainly an element of social proof to varying degrees around different organizations. Again, like, some organizations tend to be fast followers of others, and or may have accounts with other investment managers, right? Like, we or our peers who are other fund of funds, or maybe advising allocators and pools of capital, where they follow our lead in a recommendation, right? Because we are venture specialists, we are entirely focused on allocating to venture funds, and it may be useful, frankly, for a multi-asset allocator to kind of follow the quote unquote smart money, right, in a certain asset class.
Are there people or offices or other fund of funds that you don't want to partner with, right? When you invest in an emerging manager, because there's weird dynamics because of these misaligned incentives. I can't help but feel like there's some clash there.
That is a great question, and one that I'm sure it happens, and I'm sure it comes up, especially because you have personalities that may not get along. But I do think at the end of the day, it is the most GPs, the vast majority of them will have fairly diversified LP bases, right? And we typically, wouldn't be more than 20 or 30%, right, of a fund anyway. And so there are certainly lots of other personalities and interests around the table. I would say the vast majority of what we see is like everyone really wanted to be supportive, and support the interests of the GP and the founders, right? So there's really like not many cases of some of this of sort of tension and negative behavior, but it happens. It definitely happens, especially when you have sort of misaligned incentives. One thing we actually didn't super touch on is liquidity, right? And on the
Yeah.
rise of secondaries. But that's an area where we see the potential for a lot of conflict, and you've seen it, right? Because you have a new buyer potentially coming into a fund, and a seller selling out of a fund, right? And by the way, that happens at the GP level too. Like the GP, now the GPs are more active, in the secondary market. They're obviously, like, the sellers are price maximizing, right? And the buyers obviously want to come in at the lowest price. So there's these inherent conflicts in these transactions, which I think, by the way, are just becoming a much bigger part of the ecosystem, given the lack of, right, and given the capital that's kind of flowed in to secondaries. So super dynamic, really interesting time. But I think like there's a huge opportunity set there in terms of the ability to make money, but B, also a need for liquidity options.
Yeah.
Right.
Do you
So it's
think there'll be
creating
new?
value.
Yeah. Do you think there'll be
It's totally
new
creating value.
funds that will focus on secondaries?
For sure. Yeah. What I would
Yeah.
suggest in the secondary space too is actually somewhat akin to what we've seen and what we talked about in terms of the barbell of venture, right? And which is by the way also what had happened in private equity, right? Which is you have large platforms that are scaled that continue to where capital continues to flow and they continue to grow and become multi-asset, multi-strategy, multi-product, et cetera, as well as specialists. And you're seeing that, I think, in the secondary space with the rise of certain firms that have become multi-billion-dollar funds and are have primary, have a fund of funds, have direct funds, have secondary funds, all under the same roof in a large platform, as well as specialists, right? And by the way, you have some firms like Industry Ventures, which kind of specializes mostly in venture, and then you sort of have like some of the newer firms that we've heard of, like maybe specializing in a certain type of deal, like a GP-led deal, or specializing in direct secondaries in top 20 private companies, right? Like it's like there are different flavors of specialization that are kind of happening in the industry, which kind of mirror what's happened in venture.
That's very
kind of
exciting.
at large.
Yeah. Well, it's like, venture as an asset class just is shifting as
It is, for sure.
well, it's just like the maturity of it. Why is LP land so mysterious?
Yeah. So I think it's historically it's been pretty mysterious, pretty hard to get information or come by a lot of information on different LPs, and I think there are a number of like driving factors, and I think actually one of the bigger ones are these like sort of organizational dynamics at play in terms of allocators, right? So I'll give you an example, like the pension funds, they serve their constituents. So anything they put out there, they get judged on, right? And so you can't, like, it doesn't serve you as an allocator to share more information, right? Like there's no upside, I guess, to being more transparent. Then there are other policy level things, right? Which is like, certain groups may not, like, they may have a policy against talking to the press or talking to, like, because their strategy, right, like, and their portfolio is like their edge is in like their access, right, and the names they're able to be in or see kind of early on in terms of driving their returns, right? So like there's some of that of like, hey, like, and this is not just at the LP level, right? It happens at the GP level too. There's certainly tons of GPs that prefer to stay a little more under the radar and not really broadcast, their investment strategy too much.
I was really happy to see that Sapphire Partners did a collaboration with CalSTRS. Were you involved at all in the origins of that collaboration?
Yeah, absolutely. And they, to their credit, they've been a fantastic partner. They have been partnered with some of the most storied, venture capital and private equity firms, and in the past, and from early days, right, from when these firms were emerging managers themselves, right, or were in their first few funds. And we're fortunate to kind of partner with them on their venture emerging manager program, as well as to serve, that organization and their constituents, right? Like that. There is frankly, a beautiful flywheel about the cause that we can support and serve, about how bought in their team is in terms of serving their constituents as well, and in making money to support California's public school teachers. It's a really awesome mission that also helps kind of align some of the GPs, the investors that we back, right? Like they want to see their efforts go towards greater things, bigger than themselves as well, and good causes. So there's a positive kind of reinforcing mechanism in the relationship, which is really awesome.
Is there ever any conflict of interest where, let's say, you guys back a emerging manager that is excited about ed tech, and they invest in a company that may put teachers out of business. Maybe it's a tool that helps teachers, but they may look at it as a way that it hurts their job security. What happens there?
That's a great question. It's so far it's not one that we've had to address directly. What is a little what where we have kind of seen at the periphery is actually, I'll give you an example with the recent trend in defense tech, right? And VCs investing in companies that produce weapons, right? It becomes controversial, right, because of potential headline risk and or some of the ethics around, funding things that could be, or technology that could be used to kill humans, for example, right? And so it like that issue has become very topical, and become something that we've had conversations with our investors with, and they're also having those conversations with their constituents, with other partners, and it's certainly an increasing topic of importance these days.
Well, so then how do you balance it?
Sorry for the cop-out answer, but it's a little situationally dependent. It kind of depends on sort of the nuance, but it requires going deep too. And at a certain point, there are policy level things that, issues that cannot be crossed, right? It's like they have a very specific investment policy that would, for example, I think prohibit certain types of investments, right? And if a fund manager were to cross that line, like that is essentially, you can't do that. You've agreed to not do that, in the previous stipulations, either in your LPA or, through an agreement, side letter agreement.
Gotcha. Okay.
But so there are certain rules that can't be broken, but there are other considerations like this. It is a gray area, right? And it requires deeper kind of analysis and discussion. Yeah,
Totally
but it's a
makes
partnership,
sense.
right? So it's like you do want to balance the return potential, and relationships with, the fund managers, as well with some of their other considerations, like we touched on earlier, right? Like they have like organizational dynamics or headline risk, or other perceptual sort of questions to wrestle with, and it is a like balancing all of those competing objectives, is certainly
It
a
sounds hard.
challenge.
Yeah, it sounds very difficult. I wanted to go back to talking about how each fund is a product for LPs. I have been really obsessed with the separation between new venture and classic venture. New venture is more of like an AUM game. It's about money deployment. They can afford these insanely high seed Series A rounds, whereas classic venture is more about like artisanal venture, which we're seeing more about with the exodus of tier one partners leaving. I was curious, as an LP, when you're seeing this sort of split, right? How are you thinking about your portfolio, right? Like, what is the percentage of, new funds that you want to back versus the franchise funds that you will continue to stay with the fund over fund? I just want to hear your thought process around that.
Yeah, absolutely. And I'll caveat this with our approach being focused on early stage venture, and therefore we tend to not have once a firm really shifts into growth stage or later stage investing, it tends to not be a go forward fit, for our investment criteria at this time. And I would say we typically, but there are certain firms and relationships that we've had for a very long period that continue to dominate their area of early stage venture capital practice and have become franchise funds. One of the threads and through lines is that we leverage our trusted relationships with these GPs to identify and diligence and reference kind of the next generation of great managers, kind of leaving other firms potentially, or even coming through their networks, right? Like, and through their their portfolios.
Right. Well, okay, that gets me thinking. When a manager that you've already invested in wants to change or add a strategy, what is that? That puts you in a really tight spot, right? Let's say they want to go multi-stage. What if they want to have an LP arm like Sapphire does? Or what if they want to start investing globally? How are you guys thinking about that?
Yeah. And I'll say we kind of come at this from, again, a position of a trusted relationship. And we know that our managers and our GPs do not take these decisions lightly, right? So usually when a expansion, new product, new strategy, growth kind of comes about, it's been a long considered decision. It's very thoughtful. And our general approach is to be supportive, right? Like we want to be long-term partners with folks and continue, supporting them. But we also recognize that we should be asking questions, right? We should be asking tough questions to really help them pressure test, their theses and I think they find it valuable to coming at it from an outside in perspective, right? And helping them as a thought partner with our perspective, seeing lots of other firms and having seen firms, expand and grow successfully as well as pitfalls to avoid
Mm,
and
yeah,
mistakes to avoid.
yeah. When you're evaluating new funds, do you have an opinion on the big VC platform versus just a thought partner as a fund manager?
I actually think this is I'll say I've heard a very famous VC kind of discuss their outlook on the future of VC, which was eloquently put as a barbell, right? Meaning, in going forward, anticipating that what we've seen in terms of concentration of both capital and talent and resources in a few number of very large platform firms, um, combined with the emergence and growth of the specialist groups within venture and specialists, in there's certain other many types of areas where a firm may specialize. It could be, a particular, vertical or sector. It could be a particular stage. It could be a particular founder archetype, right? But that the specialist firm will have a unique and compelling value proposition, which, in order for them to be successful and, be in the best companies and generate, a compelling long-term returns will likely fit nicely, with in a paradigm where there are where there are where there are a few concentrated pools of big platforms. It's almost a Darwinian argument. Like, in order for a firm to survive and to do well as a specialist, right? Like, they have to have some kind of compelling value proposition, real value proposition, and distinct, edge versus versus the few platforms that can provide lots of capital at potentially higher prices, who have a lower cost of capital, right? Who have more resources.
Something that I was always curious about. They have to obviously show that they have a unique wedge into the market, which is what we were alluding to. But at a certain point, like if their angel track record is just so good and you like them as a person, is there a point where you just say, we're in? Like the wedge is that we know that you're amazing, and that's it. Like a generalist emerging manager fund one.
Yeah, it happens.
Yeah.
It happens, and there's a um the narrative also becomes specific.
I'm gonna move into a few fun questions. I had Winter Mead on the show not too long ago. He used to work at Sapphire. I believe he was there at the inception of OpenLP.
I
Um,
just saw him 2 days ago.
oh, I
So hi,
love it.
Winter.
That's awesome. That's awesome. I asked him what a fun question to ask you would be, and he said to ask you, who are the pools of capital still investing in funds with less than 50 million in AUM?
Shout out to him as for being one of the few that are sort of top of mind for that with Coolwater. But in addition to that, I definitely want to give a shout out to Screen Door, who we're also partnered with, who will definitely back folks at that scale with catalytic capital, right? So like certainly recommend that folks talk to them early, in their journey. And also my alma mater, Industry Ventures. They're fairly active in partnering with very small fund managers, and not afraid to be to even like help folks get off the ground with their very first funds or do SPVs or whatnot.
Well, so I was interested in how emerging managers come up with their fund size. So they need to find the right fund size to execute their strategy. They also have to think about reserves. They have to pay themselves too. Um, I've been reading a lot about how your fund size is your strategy almost. That's Mike Maple says that all the time. The team at Floodgate's a big believer in that. What goes in the mind of an emerging manager on your side where you guys come to alignment on a fund size? Is that something that they come to you and say, hey, we want to raise this size fund? Or is that something where you're like, well, actually, we're going to set the fund size, like how VCs kind of set the cap if they're leading the round?
Yeah. No, it's a great question. And I think at the end of the day, what we hope is that the GP will execute an authentic strategy where they have an edge and a competitive advantage. And it's very hard for an LP to tell them one way or the other, right? That your fund should be much smaller, fund should be much bigger. And we want that to be driven by what they truly believe they can execute on and generate outsized returns. Just like a VC would want to back a founder who has a very strong vision and is going to execute against that vision, right? Where the investor can't really tell you, what to do, but can perhaps shape some of the contours around it, right? So I think, and especially with newer fund managers, sometimes it is a question of, well, what is the right reserve ratio? Or what is the right portfolio construction in terms of numbers of companies and or maybe ownership to target or any parameters around valuation. And I think we come at this with we've seen that there are many ways to make money, right? So we were in SV Angel funds that have over 100 companies in them, right? And it's not an ownership sort of question. It is a back the best founders and have many of them in the portfolio kind of question. Those funds have been phenomenally productive funds, but we've also backed folks that are much more concentrated, more like even fewer than 20 companies in a portfolio, 15 companies in a portfolio, higher ownership. And so if it works, it really drives returns when you get, a power law type outcome. And we are believers in the power law, of venture outcomes.
Yeah. Well, I guess we talked a little bit about platform teams. I kind of want to go back and talk about platform as an LP. VC firms have these like platform teams that help their companies succeed. Is there such thing as LP fund support platform teams?
Yeah, I can't put my finger on specific like platforms that are top of mind. But there's certainly value-added services that LPs will, provide. And this also goes outside of venture. There are certainly other groups where, especially targeting newer fund managers and helping them institutionalize, they'll provide advice, back office support, even direct resources, sometimes in exchange for an interest in the management company or the GP or some kind of financial arrangement. But yeah, I think that concept certainly exists in LP land. But it's also not one that's heavily discussed or as is if you were to canonically call the Andreessen Horowitz type of platform, there's not a clear analogy, in LP
Gotcha.
land.
Okay.
That's top of mind.
What is the biggest compliment an LP can receive?
Yeah, I love this question, and I think it goes back to at least how I think about the value of building trusted relationships, and why a lot of LPs are in this business is you can partner with fund managers and with, these great investors over a long period of times. And it can be financially super productive as well as very rewarding, from a professional relationship kind of standpoint. And so I do think the highest compliment is indicators of like building a true trusted long-term relationship. And some of the very specific ways that this can play out would be, a founder introduction, right? Where you trust the LP so much that you're going to introduce them to one of your founders, potentially for a co-investment, right? To actually partner directly with this founder and with this company. That's an incredible compliment. Also, trust in their judgment and their ability to generate returns as well, to, invest in their funds and in their products. We've definitely seen that both in this Sapphire kind of network, previously at Industry Ventures, as well as at Bain Capital. It's a super high form of praise in that trust.
Yeah, I love it. Last rapid fire one. What's something that you learned the hard way?
I guess in making an investment decision as a team, I've learned, I've made the mistake of being too academic about an investment decision, right? And I'll describe it, very bluntly, like putting out what I thought was a very well thought out, investment memo and an investment recommendation that had not been appropriately socialized, right?
Oh,
And
interesting.
so not getting enough alignment before jumping into a decision, and probably overestimating analysis and your own kind of work without, incorporating as much of the team, and broader investment committee's input. That is certainly a mistake I've made, but, recently, not too frequently.
Okay, that's good. That's good. Was there a fund that you missed out on because of that you keep kicking yourself about?
Man, there have been many funds we've missed out on. We were very close in terms of partnering in a prior fund, and it ultimately didn't work out because of legal, negotiations, which I believe could have been addressed earlier in the process. I reflect on this one a lot, actually, and so one of those learnings is to raise some of these issues in terms of legal negotiation, probably earlier. So that's certainly a learning.
Yeah. Well, it's very helpful for also like aspiring emerging managers, like have those legal conversations earlier too, if you really want an LP to come in.
Ask about it, or maybe raise it in a discussion. I think the way that most investment processes kind of work out, at least on the on our side of things as a LP, investing in an institutional venture fund, you have your early conversations, right? You have your data room work, your analytical work, more meetings with the GP and kind of getting to know them, and references and all this stuff. And legal is kind of the last step, right? Where you sign up to the LPA and whatnot. And I think you want to know that you have conviction, you're in this relationship before you kind of get down to the nitty gritty legal pieces. But sometimes it is useful to kind of have that discussion a little earlier.
Right. Absolutely. Oh my gosh, I'm having so much fun, Nate. Unfortunately, Nate, our time has come to an end. After this awesome conversation, it's time for the final ceremonial ask, which are 3 final questions for you. Nate, are you ready?
Fire away.
Okay, we touched upon a lot of these questions throughout the episode, naturally, but in the spirit of being new to venture, if you were to write a letter to your past self, right, as you were starting in this chaotic, hectic world that is venture and startups, what would you write about?
Yeah, I think we touched on one of the most important through lines, which is trusted relationships, with people, and that, all of the people in this business, are people, right? They're individuals with, incentives and motivations and, goals and their own sort of situations, right? In context, and understanding that context is super important. And how this would play out in terms of advice to my younger self would be, one, we touched on potentially being a little too analytical or overly sort of persuasive, through an analytical lens, and not accounting enough for that personal, lens, and building trust and credibility in advance, right, of making a recommendation, an investment recommendation. Um, and a kind of tangential, piece of advice that I would, also give my earlier self, would be to find mentors outside your firm who are more experienced and more senior. And I think, I guess this maybe like relates to a reflection I personally had about some of these learnings, right? Which is, as a as a young professional, I think it's easy. Well, I think it's common to focus on your job, focus on your firm, focus on like nailing, and really doing well the things that are expected of you. And in terms of finding opportunities to get that mentorship, which is hard to come by in venture, right? You have to be pretty proactive to get mentorship in this business, and in any business, frankly. That I would recommend going and being thoughtful about finding outside mentors, who you
Yeah,
can trust.
I love it. Nate, thank you so much for joining me. I'm looking forward to seeing all the amazing progress that you'll make. And next time you're in New York, dinner's on me.